All right, let's look at Strategy Inc. Class A. Right now, the stock is trading at 227.60, and it is taking a significant hit, down $9.60 or 4.05% on the day. Now, the immediate reaction for many watching this is probably confusion. This is supposed to be one of those smart B2B companies, the ones that help other businesses navigate uncertainty. The expectation is that in a complex economy, demand for their services should be high. But today's 4.05% drop isn't just noise. It's the reality of the market pricing in a very different story. A story about discretionary spending and the true pecking order of corporate needs. When the market sees a name like this falter, it sends a ripple. It's not as headline-grabbing as a drop in Tesla stock or Apple stock, but in many ways it's more telling about the real health of the economy. For months, the narrative around Strategy Inc. has been one of resilience. You hear it from analysts, you see it in the bull cases. They provide high-level corporate guidance, data analytics, and implementation frameworks. The belief is that this makes them essential. But here's the problem with that belief. It mistakes valuable for non-discretionary. This 4.05% slide today is a perfect example. It's not happening in a vacuum. We've seen a pattern of this over the last few weeks. Look at the trading volume today. It's elevated, sitting about 30% higher than its 20-day average. This isn't just retail investors on the Robinhood app getting spooked. This is institutional money moving. When volume spikes on a down day, it signals conviction in the selling. We're seeing large blocks being moved, likely through platforms favored by professionals like interactive brokers. Why the move? The macroeconomic picture is becoming clearer. When a CEO has to choose between keeping their production line running and commissioning a new 6-month strategic review, the choice is obvious. Strategy Inc. sells an optimization product, but the market is now in survival mode. This sell-off suggests a major client pulled a contract, or perhaps a competitor just signaled a price war, or maybe an analyst firm finally downgraded them based on this exact cyclical risk. This kind of analysis is crucial, whether you're a self-investing enthusiast or using sophisticated tools. It's not just about the chart, it's about the why behind the candle. This is the kind of detail that separates a good online investment from a bad one. People looking for investment help often miss this nuance. They see a dip and think buying opportunity, but they don't ask why the dip is happening. Let's broaden the lens. This kind of volatility isn't isolated. We see similar pressures on parts of the tech sector, even on giants like Apple stock when concerns about high-end consumer spending arise, or Nvidia stock when data center budgets get reviewed. Strategy Inc. sits at that same intersection of high-ticket B2B spending. The market is jittery. Investors are trying to find safety. Some might be rotating out of individual stocks and into broader Fidelity ETFs or Fidelity mutual funds, trying to diversify away from this exact kind of single stock risk. This is where your platform choice matters. If you're trying to execute a trade on this, are you using a simple Fidelity mobile app, or do you need the advanced order types available on the interactive brokers trading platform? A 4% drop can wipe out gains if your execution is poor. Even robo-advisors are factoring this in. A system like Schwab Intelligent Portfolios or a SoFi robo-advisor is, right now, reevaluating its exposure to consulting and B2B services sectors based on this new data. They are built to react to this kind of volatility. The common expectation is that a company with a strong track record like Strategy Inc. supposedly has will just bounce back. But reality is that the ground has shifted. We're not in the zero interest rate environment of a few years ago where any growth story was bought. Now, cash flow is king. And if Strategy Inc.'s clients are hoarding cash, that means Strategy Inc.'s own cash flow projections are suddenly in doubt. This isn't a complex Tesla stock valuation problem based on future autonomous driving. This is a straightforward, are customers paying their bills problem. It's a very different kind of investment thesis. Many investors new to online investing get trapped here. They open an individual brokerage account, maybe at Fidelity or SoFi, and they buy what they know. But knowing the company name isn't the same as understanding the stock's behavior. Using SoFi Invest or the Robinhood stock trading platform makes it easy to buy, but it doesn't provide the why. That's the hard part. That's the analysis. This is why the Fidelity brokerage platform and the SoFi trading platform are likely seeing high activity on this ticker. It's not just a buy or sell, it's a reevaluate. If you're a long-term holder, perhaps in a Fidelity IRA account, you're not supposed to panic, but you are supposed to ask if the long-term story just changed. Is this still the company you thought you invested in? So what does Strategy Inc. actually do to justify this $227 price tag even after today's drop? Their core business is split into two segments. First, the classic consulting arm. They send teams into large corporations to analyze workflows, market position, and competitive threats, and then they produce a strategic roadmap. This is high-margin work, billed by the hour, and it's their legacy business. This is where they built their brand. The second segment, their growth segment, is a SaaS platform. This is their data analytics and implementation software. The expectation was that this segment would provide stable, recurring revenue, insulating them from the cyclical nature of consulting. This is what all the bull cases have been built on for the past 2 years. They've been trying to pivot from a service company to a product company. And this is where today's reality hits hardest. That 4.05% drop, what if it's signaling that the SaaS adoption is stalling? What if clients aren't renewing? If the SaaS story breaks, the entire valuation model for Strategy Inc. collapses. Historically, they've beaten earnings expectations by managing costs and securing large multi-year contracts. But past performance, as every Fidelity Investments prospectus says, is not a guarantee of future results. The market is a forward-looking mechanism. It's not looking at last quarter's success, it's looking at the next 2 quarters of pain. This is the counterbalance to what any Fidelity Invests SaaS product might be touting as its key selling point. Where does this go from here? Let's map out the scenarios, again through our lens of expectation versus reality. The bullish expectation is that this is a temporary, fear-driven sell-off. The bulls will say that corporations must invest in strategy to survive, and this dip is a fantastic buying opportunity. They'll argue that the SaaS platform will create a sticky ecosystem and that the company will announce a new major client any day now, sending the stock right back up. The bearish reality, however, is much more tangible right now. The risk is that this 4.05% drop is just the beginning. The risk is that the next earnings call will confirm a slowdown in contract velocity. The risk is that their strategic advice is now seen as a luxury, not a necessity. If we see a broader economic contraction, Strategy Inc. doesn't have a moat like Apple stock's ecosystem or Nvidia stock's hardware dominance. Its moat is its relationships and reputation, and those can erode quickly when budgets are cut. Investors need to watch the 225 level very closely. That's a key psychological and technical support line. If it breaks that, we could see a rapid flush down towards the 200-day moving average, which is sitting closer to 210. On the flip side, for any sign of a reversal, we need to see volume come in on a green day. We need to see a clear sign that institutions are stepping in to buy this dip, not just retail traders on Robinhood trying to catch a falling knife with Robinhood fractional shares. This is a moment for serious thought for anyone holding this in their Fidelity IRAs or as part of their Fidelity wealth management plan. Is this a long-term hold, or is it a cyclical trade that has just turned sour? I'm curious what you all think. Comment below with your thoughts. Is Strategy Inc. a buy-the-dip opportunity, or is this the start of a much larger correction for the B2B services sector? Let me know. This is the complexity of modern online investing. You have so many investing sites and tools, from SoFi Invest with its mix of SoFi stocks and SoFi ETFs, to the deep professional-grade data at Interactive Brokers. But the tool is just a tool. The SoFi Active Investing Platform and the Fidelity Trading Platform are both just conduits. Your success depends on your ability to interpret days like today. It's about looking at that 4.05% drop and seeing the why, seeing the tension between the story we want to believe and the reality the market is showing us. For those managing their own individual brokerage accounts, whether at Fidelity or using the Robinhood app, this is a test. Do you have a stop loss in place? Did this 4% drop trigger it? Or are you a long-term believer? If you're using SoFi Investing or Robinhood Investments, the ease of trading can be a double-edged sword. It's easy to buy,